All right, so we had the worst Christmas Eve ever on Monday, and then took the day off yesterday. I hope you all had a good Christmas holiday. But then today, the market has its biggest gains on the absolute level, the biggest point gains ever, to reverse and then some that really negative Christmas Eve that we saw. So what does that do, and how does that change our posture? That's what I break down in tonight's video, as well as we can take advantage of this short-term significant rally and see if we can't get a decent trade idea to take advantage of that. So let's go ahead and get started. Today is Wednesday, December the 26th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and start off by taking a look at the S&P 500 with the market forecast indicator. You can see a big jump in short-term sentiment, but you know, when you have 6 consecutive clusters, it's hard to get that near-term line up above 50 on a almost 5% day. But we did pretty much erase. We closed the Thursday before expiration at 2467.42, and we actually did close up above that mark today by just a few pennies. So in other words, we just completely erased the day before expiration and Christmas Eve in one day today. Again, the bigger the declines that you see here, the more extreme they are. Eventually, the bigger the bounce will be. And as we mentioned before, you know, these reversals don't occur, and I don't even know if that's necessarily enough of a long lower shadow. But these major weekly reversals don't occur without long lower shadows on the chart, and we're starting to get one here so far today. You can see, you know, if I were to look at ES instead, the long lower shadow on ES is even more pronounced because there was more selling in the after hours. So it kind of gives you an idea that, you know, the market, as we mentioned before, long lower shadows on weekly charts mean that you have a really bearish start to the week, which is what we did. We had the worst Christmas Eve ever, and whether or not this turns into a reversal or not, it is a really good sign that you're at least getting, you know, closing above the high of the low day. Yesterday being the low day, in fact, we're closing above the open of, you know, 2 days worth. So a nice little snapback rally. Had a big impact. Crude oil was a big driver of that. It jumped up over 6%. MLPs jumping up over 5% on that news. Look at the Dow Jones Industrial Average. You can see its short-term sentiment improving as well. Again, closing well up above Monday's high point, well up above it. The NASDAQ Composite, again, had all these clusters. Similar short-term sentiment, closer to 50 than the rest. Not quite getting above, but still a bullish reversal pattern here. And then the Russell 2000 looks very similar to the S&P. And again, none of these have either the red line, which is the momentum line, up above 80, or at least above 90. That extreme momentum level is that sign of an intermediate trend change back to being bullish. And remember, when the intermediate trend turns bullish, it's going to be light green at first because we've been dark pink for so long. So it's going to be light green first, and then when it crosses above 50 is when you turn dark green. So obviously that's not going to happen probably by the end of this week. Most likely not in this week. And short-term sentiment is not even telling us to expect that yet, because you either got to get one of two things. You got to get the momentum line above 90 or the near-term line in blue above 80. And when you get multiple clusters and you're just, you know, you've got this cascading waterfall effect, it's not as easy to bounce up. The last near-term high point was way up here at 2650-ish in that area. So more than likely, the next near-term high, when the near-term line gets above 50, is not going to be a higher high. I would venture to guess it's probably going to jump up, at least maybe initially hit some resistance at 2500, big round number, but especially at 2600, which was a strong support before. Now, since you broke through it, it's going to act as a strong resistance on the way back up. So I would venture to guess this near-term run, if and when eventually it gets above 50, won't quite get up to those levels yet. But, you know, obviously we bounced up 5% today, so anything can happen. But I doubt that will happen. Then you'll get a near-term pullback, getting the blue line back below 50, and then obviously you'd have to close that near-term pullback higher than 2350. Then you get a higher near-term low, and you have a better chance to sustain a new intermediate trend. But right now, again, as we've mentioned before, any bounces like this is just going to be a bounce back up to to some old resistance levels off of this steep losses. Okay, before we look at some other charts, a reminder to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that subscribe button that pops out. Also, click the thumbs up icon. That tells me, number one, you got something out of the video today. Number two, you want me or Brandon to do the video again tomorrow. If you don't want us, if you're not that interested in the videos, then of course you don't have to click anything. Also down below, comment on what stood out to you. I always like to read the comments to see what did you get out of tonight's video, what questions you might have, or what other comments on what we didn't cover in the video. You can throw all those down at the bottom. Join our daily market outlook email list. There's a link popping out in the top right corner of your screen. Click that link up there to subscribe. 392 stocks in the watch list yesterday, in Monday's email. Only one stock with an oversold cluster in today's email. So we went from almost 400 stocks out of 500 all the way down to one. So subscribe to the list to see which one it was. Follow me on Twitter for more content that I put out there throughout the week in between these videos, so we can keep the conversation going. And then join our Market Outlook community that we created on Facebook. Also, if you're watching this on our blog, this page has a lot of information for you, including our calendar of classes that starts back up next week. You can subscribe to our site for free and to be able to participate in our forums with other market scholars. There's a link right there at the top of the video to get to our Market Outlook forum. And then finally, 3 clicks tell us you want us to do this video. You can do this right now. Click this heart right here in the bottom left. That opens up a new window that takes you to your Twitter account. You can like today's Market Outlook tweet from there. Click on this image. You can like the Market Outlook post on Facebook and share it with other friends you think might be interested in it. And then thirdly, you can click this like button right here. Remember, you can also share this video across Twitter, LinkedIn. You can send it through an email. You can post on Facebook. All these buttons down here. That's a pretty good number for us. And again, remember, our goal is to get that number to 100. So if you think other people would want to see this video, use these icons to share it across any of those platforms. All right, now let's look at a long-term view of this. And remember, these Fibonacci retracement levels are the retracement off of the 2016 lows. So basically, we went through the 50% Fibonacci retracement a little bit today, and we'll see if we end up getting a piercing line. We have to get back above 2508 if we're going to really make a run towards the 200-day moving average, because that's the top end of this retracement zone that we're in right now. We'll see. Obviously, anything can happen. That's not very far away, not nearly as far away as it was today at the low point when we were at 2346. A little bit below the 50% retracement. So that's kind of the expectation there. Again, I'm not expecting us new all-time highs in this next run. I actually expect that we'll hit up into this 2600 first, if not this right where the 200-day moving average next. And then we'll see if it holds it for resistance and rolls over like it did in early 2008, or if we break right on through it just a few weeks after coming below it. That latter scenario is more doubtful. The former scenario is actually a lot more likely. If I were to show you back, this is that 2008 period where we broke through at the very beginning of the year, the 200-day moving average. In this case, we only got to the 38% Fibonacci retracement before we made a move back to the 200-day, and that failed. And then that's really what started the bear market, and we fell off the cliff a few months later. This is probably the scenario that we're in right now. So we're going to watch to see as we move back up. Here, like I said, it didn't get to the 50% Fibonacci retracement, but it did get down to some support, and we're going to look for a similar pattern now going forward to see if we hit the support and bounce back up to the 200-day moving average, and then what does it do there? Does it break on through like it did in these two periods, or in 2011, 2011 right here, we got down below it. We made a move up to it, eventually broke through it. And again, this pullback in terms of how far away we are from the 200-day moving average, how big the range is very similar to what we saw in 2011. It doesn't look similar because this is not a logarithmic chart. If you were to look at it on a logarithmic basis, they're very similar. So here it is on a logarithmic chart. There's the pullback in 2011. Again, if I were to even just go from here where we first peaked, had that head and shoulders pattern and came down to the low right there. So if I were to duplicate that and move it over to this level, you can see, and let me get rid of, here we go. So if you look at the numbers here, I'm using a logarithmic chart on profit charts. You can see that was about a 20% drop in 90 days, and it had a minus 74-degree angle on that decline. Again, you can see that 1/4% per day. If you look at this one now, you can see again about 20% over a little bit more than 90 days, so almost 1/4% per day in the similar angle. So when you look at it in the logarithmic chart, it's a very similar move to what we saw now, to what we saw in August and into October of 2011. And you can see we did bounce up through in 2011. We did get up to the 200-day moving average. We didn't push like 2008. We didn't fail and go to new lower lows. We actually busted through with a new golden cross, return move a couple of times before taking off. Keep in mind, quantitative easing kind of got that ball rolling. We are not in that type of fiscal or monetary policy environment as we are now, where we're getting tightening and rate hikes. See, when the Fed lowered interest rates to zero, they were doing quantitative easing by itself. And right now what's going on is they're not doing they're not just raising rates and not doing quantitative tightening, or they haven't stopped raising rates and started now to do the quantitative tightening. They're doing both at the same time, which is and some people feel too much, and that's what sparked a lot of this investor sentiment, just drawdown in investor sentiment here. Again, it hasn't been fundamentals that's produced this big drawdown. It's more been headline and sentiment driven, and that's what when that's the case, that's when you get the sharp rallies back up, and again, at least to the 200-day moving average, at least at 2600 first, and then we'll see what happens from there. So again, we still have 3 red arrows, and the first green arrow is most likely going to be the stochastic indicator. So when we break that down, where's the stochastics? In here. And remember, I told you too that it's rare for us to stay this far away from the 8-day moving average. Whenever I showed that to you on Friday, here it is. We change that MACD to today, and then the 8-day moving average here. If it'll let me, there we go. So notice it doesn't stay down, and it jumps right back up to the 8-day moving average. Remember, reversals occur in stages. You get up to the 8-day moving average, and you still write it down. You get through the 17-day moving average. It's the next stage. And then obviously getting the green arrow on the 30-day moving average, with both these lines following, crossing up above. So that's obviously not going to happen anytime soon. But as we mentioned on Friday, we did get the bounce. We're so far away from the 8-day. We did get that bounce right back to it, essentially all in one day, as we've seen has happened in the past. Again, if we were to show similar to what happened in 2011, to give you a sense of, again, those snapbacks. And again, we were about 135 points away. So in 2011, we got 104 points away, which is a much bigger deal, a much smaller number. So we got really extended away, and you see how we came back up above it. But we didn't get above the 17, and finally did there. Then you had some consolidation, another new leg lower before rallying. Things get messy when volatility is high. But that was another extreme, and it didn't stay down that far away. We jumped right back up pretty sharply there. If you look at today's range, was about 12.5 points, almost double the ATR, and well up, more than 2%. 2% of the price right now is going to be like 5 points. So even the ATR is above 2%. In fact, if you look at the ATR here, and you'll see the volume at 218 million. So let's go to the ATR. It's almost, it's getting up to 3% there. And today's move just helps it, because it was a really, really strong trading range, over almost 12.5 points, and then the volume at 218 million was well above average. So, this is not your typical between Christmas and New Year's type of a move. A lot of volume, big trading range, and a little bit of a drop in volatility. It didn't drop. It still hasn't gotten back to pre-expiration lows, but we're pretty close. and you can see we're still above the 115 surge level. See, the red level is just like, red alert kind of a deal. And then the 115 is your normal surge level. 105 is extreme. So we're really at extremes here, which means you're going to get big moves in both directions, to the upside and the downside, like you saw in August 2011. So don't buy the hype on the big bounces, and don't jump off the cliff whenever we get another leg lower and we retest those low points. Things get messy when the VIX is high, when it's above 105%, much less above 115 and 125% of the 3-month VIX. So to summarize, we had a nice, good bullish bounce today, and the biggest point gain for the S&P and the Dow, but only because their levels are so high compared to where they were in 2008 and 2009 and 2011 and 2002, where some of the other bigger ranges have occurred. So it was a good sign. We stopped the bleeding. But we're not necessarily starting a new bullish trend yet. There's going to be some big ups and downs, like we mentioned before, and bigger than what we mentioned before, because we're a lot higher on the volatility. So, again, there is the expectation that we're extremely oversold, and there's going to be a lot of buying opportunities here, but it's not going to be one of those back up the trucks buying opportunities. You have to still manage risk with smaller positions during these volatile times. Once the volatility index drops below 90%, we're on a trend. We're ready to go. Until then, when it's this high especially, there's going to be a lot of moves. So that's our market outlook for today. A good sign. The bleeding has stopped per se at some Fibonacci support, but we're still in that retracement area until we break out of it, until we break back above 2600, much less getting above the 200-day moving average. There's going to be some big moves. The biggest up moves in the market have occurred when the S&P is below its 200-day moving average. So expect more moves like today, as well as like we saw on Christmas Eve, until we moderate this volatility again. All right, now let's transition to what's driving the action today. And we talked about the possibility, and I've talked about it in my technical analysis class last week and the portfolio management class that I taught, that any bounce we get, if it occurs this week, because it's the holidays and typically has lower volume than other weeks, especially on a 3.5-day week like we're getting this week, and for that matter, a 4-day week next week. When you get those kind of moves, lacking any headlines that can drive sentiment, then you just get technical snapbacks, and that's what we got. We got a technical bounce in the worst areas. Crude oil jumped up, it's S&P 500 jumped up, and IWM jumped. Now, all of these were some of your biggest winners. You can see growth stocks did well, S&P, crude oil, all rallying. Value stocks rallied too, to a smaller extent. So did dividend stocks and real estate stocks, all of them outpacing international stocks. In fact, if I pull up the international areas here, you can see the U.S. market actually had the best performance of all, out of all these foreign markets. And Germany and France, they did well, and emerging markets have been doing better. They lagged a little bit today. You can see there's EEM, most of your big, India, and see, that's Italy. It'd be India, and where's China? FXI would be right. Oh, there's China, Brazil, India, Russia, right there as well. You can see there's your big emerging market players, all lagging behind Germany, France, UK, as well as some of these other Netherlands, Switzerland, Canada, and Australia, all outpacing today to the upside. Again, they had the bigger losses and they bounced up the most. Here's what their bounces look like on their own individual charts, all coming off of clusters, all big moves today, but still all below red moving averages, including the U.S. So, again, we're not going to be, except for India, which is above a rising. It's the only one that's above a rising moving average. And look at its intermediate posture is close to 80 again, whereas everything else is in the single to double digits. The teens. Korea and Brazil are in the teens. They're the least away from their moving average and the rest of them. So, emerging markets, again, if we do turn into a bullish run here for a while, those play, and it would be a longer while, right? Market sentiment's down to low levels on the market forecast chart. Here we go. market sentiment on these. Remember, on the Russell is below 20. All the rest of these are way below 20. So if we do get a long-term run similar to 2011, where, again, go back to 2011 here, and we'll do a daily chart so we can see what it looks like market sentiment-wise. Here, let me get rid of the colors so we can zoom in a little bit better. All right, so now let's go to 2011. You know, the last big pullback that we had here, market sentiment also got down to the 20s. By the time things turned around and we got up above 50, we still got a pullback, a pretty deep pullback, even after that initial surge to the 200-day moving average, or above through the 200-day moving average to an oversold cluster. So a nice, good surge there. We still had a decent pullback into that Fibonacci retracement zone before we, got going and really got going in 2012. From a sector rotation standpoint, not surprising, your two best performers are technology and discretionary, communication services, and energy, all beaten up the most, all bouncing the most. Utilities and staples and real estate were all up, just lagging, and healthcare also lagged, but not to the same degree. So those are all your safe haven areas. So not surprising to see the large bounces if I were to take a look at the 12 grid for the sectors. Again, in the rankings, current rankings for the sector selector tool, Brandon's proprietary ranking tool that he's created. But you can see all the big bounces, all still below falling moving averages. So we're not close to any kind of major reversal yet. But as for now, all those clusters that we've been getting, that bleeding has stopped for the time being. Here's what it looks like on the two-week chart. Again, energy down the most, technology also down there, discretionary down here at the bottom. They're up the most. And as of right now, your best performer here is this financials and materials. They've been bouncing quite a bit here today, to the point where they've only got now a 5% decline over the past 2 weeks. Whereas we were in double digits here. Of course, energy rallying and all these other safe haven areas lagging behind during the bounce. Even if they didn't drop as much during the declines, they are bouncing up the least as we do rally up again. And remember, we're not going to flip the switch here to a 15% move on the opposite side anytime soon. There's a lot of resistance up here in this area. But again, when we're that extreme and that far away, especially on a 2-week basis, 10+% away, then that's the type of move. You're just going to get a mean reversion move. It's simply, that's all it is, just a mean reversion technical bounce of extreme oversold levels. Again, that's when you set that new higher low point, then you'll have a better opportunity to sustain a bullish run. This kind of a bullish bounce is very, very hard to sustain without volatile moves also to the downside. Alright, so for our trade idea of the day, I want to take advantage of one of those technology stocks that bounced up so hard, that had been down so much, and that's Adobe here. It's bounced up to its 8-day moving average, big reversal type candlestick pattern, but again, like I mentioned, I expect a lot more short-term volatility, and we'll take advantage of this big rally to the upside to see if there's any more moves back to the downside, especially on a stock like Adobe. It's got some resistance up here, like the market does when it bounces. MACD is very low, still below its moving average. Stochastic's below, and you're just barely a smidgen above the 8-day moving average. That 17-day and the 30-day, for that matter, can act as a resistance on the way down, just like they act as support on the way up. So because we moved up so far so much, you look at some of these other indicators, and even like the market forecast indicator for Adobe, you can see the near-term line got above 50 and the momentum line jumped up higher, but still they were extremely oversold. You can see that where that resistance is there as well. Same thing with the Bollinger Bands here. Let's take a look at the Bollinger Bands for Adobe. You can see there's a big block of volume here, right about where we're trying to, we expect, we didn't have very much volume at all down here. We bounced back up to a block of volume. Of course, if you get through here, then your next block of volume is up at 250. So what we can do, considering that we've got plenty of bullish trades in most of our portfolio, to have something that will only take a small loss if we keep going up, which would not be a bad thing for the rest of our portfolio, but would give us something to the downside if we don't, then we can look at doing a bearish trade, like selling the 232.5 call. You can see it's got about a 55-cent spread, so it's a relatively high, but it's within 10%. 60 cents here is a little bit over on the long side, so you have to fiddle around here. You remember $1.16 on the $5 wide is where you will get filled in. If you can get filled in at $1.40, which is what the platform is saying right now is where the price is at, then we can make up about 30 cents instead of selling it at 110 at the bid price, and that will help us. Because remember, you get out, there's a 59-cent spread to the middle, and you want to try to get as close to the middle as you can to get filled in. So you can, with really expensive stocks with wide spreads, you can play around with this price to see where you try to get as close to 169. Here, remember, we are selling volatility, so on a stock like today, when it's bouncing, volatility should be dropping. So a lot of people are selling volatility. So if this thing does start to turn around and volatility rises a little bit, and we're selling volatility with this trade, and we might be able to get decent pricing closer to the mid. Closer to the mid, the better, because again, you still got, the natural price on the other side is 59 cents away to the other side. More than likely, the platform says you probably can get filled in around $1.40 to $1.69, and you don't want to do too many trades here. You can see, buying power effect is $692. If 1% risk is $1,000, then that will keep the risk small, considering simply the volatility of the situation plus the spreads. If I keep the risk small and I happen to take max loss, it will hurt, but it won't hurt as badly as if I position size normally. But then if I can get filled in good, I can get a decent credit and get about $300 on that $700 risk. That's a pretty decent return. For a bearish trade that we're taking advantage of this big sharp bounce that we had today, knowing that there's usually big upside and downside moves, and I don't have to get the full $1.54 as long as I can get half of that, so $1.40. So if I got up to $70 here, so right in this area, there's half of it. It has to get to 205, so that's down right into this area. So basically be retesting the lows, and if that happened, then we take a quick little gain and move on to something else. Obviously the rest of our portfolio wouldn't like that much if we retested the lows, but we've been doing a few bullish trades on the Market Outlook video lately, and they've been working. This one will be another opportunity to add a little bit of bearishness to our active trading portfolio. Alright, so that wraps us up for today. As always, thank you very much for watching. Probably won't do a Market Outlook video tomorrow or Friday. If I do, it'll be short. I'll be on the road, assuming there's no craziness in the market to the end of the week. We'll see, and if there is, I'll pop on and share something with you. But I'd love to hear what you're thinking and what you're seeing with that link that had popped out in the top right corner of your screen there. You can still hit that I, and it will open up all the links. But I want to hear from you in our forums. What questions you have for me about something I covered in the video, or what questions you have for me on something I didn't cover, as well as you can just comment with other market scholars on what you're seeing, and you can also do that in our Facebook group, as I mentioned before, as well as on the YouTube page down below. As always, thank you for watching. Have a great rest of your evening, everybody, and we'll see you all next time.